Good afternoon, everyone. This is Bruce Connors from Envision Asset Management, and this is the first in a series of examining bear markets since World War II and some of the factors that might have set off the bear markets, such as economics, business conditions, political conditions, and also from a technical perspective, looking at the price charts. So the first market or bear market we're going to look at is the 1946 to 1949 post-World War II bear market. So this bear market began in October of 1946 and ran through June of 1949. The main index during that time period was the Dow Jones Industrial Average, so it fell about 24% during this period. The S&P 500 really didn't start until 1957, but there are historians splice the original numbers back together as if it did exist. They're saying the S&P 500 dropped by about 30% during that time period. There was not a recession until November of 1948, and the bear market, I guess you could say, officially ended in 1950 when the former high was reclaimed. So here on the graph to the right, you see the rally in the green shaded area, and what was kind of unique about it, and the war pretty much ended here in May of 45. Germany surrendered, and then a few months later, Japan announced their surrender in August. There was a lot of pent-up demand in the economy, and there were a lot of wage controls. So this led to a series of strikes from September of 45 to January of 46. Steelworkers, coal miners, etc. And you see that in the yellow shaded area marked with the number 2. But the market continued to rally through this period. So as is normally the case with price controls, they just don't work, especially over time. There were huge shortages of meat. There was a big housing shortage, everyone coming back from the war. They needed now homes to start their families, etc. There was just a lot of frustration in general with price controls and all the shortages. So the end of the price control era happened in June of 1946. So when the price controls ended, there was a huge pop in inflation. The CPI went up by 5.9% in July of 1946. And wholesale prices for basic commodities rose by about 25% in that month. And consumer prices went up for about another 15% in the second half of 1946. And that is what really set off the bear market. It was the runaway inflation that set off the bear market. And you see the quick drop here in the red area. So the market fell by about 23% from May until about 4 months later in October. And the economy, though, continued remaining strong. Industrial production and employment stayed strong throughout this period. So for the next couple of years, the market really went sideways. You'll see here in the gray area, marked by the number 5 area, there was a 13% rally, then it dropped by 11%, then went up by 14%. This is through 1948, and inflation continued to be a major theme, but the Federal Reserve had really not stepped in to this point. So that would change in February of 1948. The Fed did tighten credit. It raised reserve requirements on the big money center banks. Now, to this point, by law, the Fed was not allowed to increase rates or reserve requirements on smaller banks, only on big money center banks. So they did that in February of 48. The first sign that maybe the economy was softening up is that farm prices peaked in January, and then they fell sharply in February. The Marshall Plan was enacted in 1948. In June, there was a second increase for the big money center banks, and that was the month that manufacturing output peaked and new orders started turning down. In August of that year, Congress passed the Anti-Inflation Act, and that allowed the Fed to raise reserve requirements in all banks, and that is what the Fed did. They increased short-term interest rates, and again, non-farm employment peaked that month, and then manufacturing employment peaked the month later. So you could see the economy starting to turn over. And then later on, it would be determined by the NBER that the recession officially began in November of 1948. So you will see here in the light blue area, right on cue, in June of 48, the market topped out and began its fall. And this chart is through the end of 1948. In the pink area, you'll see the market fall until June of 1949. The economy softened up a little. Department store sales were down by 22%, and unemployment was increasing. In March and April of that year, they try to soften up the impact of higher reserve requirements. they were lowered in April of that year. Stock margin requirements were cut in March of that year. There was installment credit controls, which I didn't talk about, but that also happened previously, and that ended in June of that year. So that was kind of when the market bottomed out, and that began the next rally. And the next rally would go from June of 1949 to August of 1956. It was a 266% rally. And on April of 1950, the Dow overtook its previous high from May of 1946. Now let's look at the charts and see if there were any technical signals that might have led you to believe that there was going to be a bear market. And for the most part, the rally was uninterrupted. Here you had a little bit of a fall off, but after that, everything was going higher and higher, a series of higher highs, lower lows until February, March of 1946. This might have been your first signal that something negative was about to happen in the future, when the market fell off and it fell below the previous low, but it rallied from there. And then kind of up here, you see a little bit of a head and shoulders pattern where the market rallies, falls off, hits a new peak, then rallies back. Falls back here, rallies again, but does not take out the previous high, and then falls below these two lows right here. So maybe this was a signal to get out. The market fell lower and then could not reclaim the previous high, and then you had the quick fall off from there. After that, goes sideways for several years before the next market rally. Another thing to look at is the PE ratio, which you see right here, this dark line, and corporate after-tax profits here in the yellow line. You'll see the PE ratio was pretty high. It was in like around 22 or so in 45, 46. And earnings really started jumping after the war. You see them popping here. The PE ratio declined dramatically. And here's like when the recession began. You'll see profits fell off a little bit, but the PE was like ridiculously low at this point. So I think the main trigger for this bear market was inflation. It was not a recession. Corporate profits remained strong. People were working. The economy was solid, but there was wild inflation during this period when price controls were eliminated. And then when the Fed did start to tighten credit in the beginning of 1948, that did lead to, a somewhat brief and light recession. And then from that point on, the market would go on a rally for about 7 years or so. So that's the wrap up of the 1946 to 1949 bear market. Next, we will look at the 1956 bear market. Thanks for watching.